Bismillahirrahmanirrahim. Assalamu alaikum viewers. This lecture series is about the financial markets. In this series, we are just going to start this lecture with what is financial markets and what are their functions. If you haven't subscribed this channel as yet, please do it and just click the bell icon for the future intimations about the future lectures. In this particular series, we'll be covering all different kinds of financial markets and their functioning. And we shall be trying to give the view to the students and all the laymen about the different kinds of the operations that financial markets perform. To begin with, in the first part of this lectures, we are basically going to talk about what is financial markets and what are its functions. You know about the financial markets. The financial markets basically have taken a very important place in the modern world. All the modern world's growth is basically depending on how the financial markets work. And this basically has been quite obvious after this financial crash of 2007, 2008. In that financial crash of 2007, 2008, what happened? Like all the markets crashed in the financial markets of the US. And what actually happened then? It didn't stop there. It actually engulfed everything into the economy. Like say, for example, that the real sector actually is connected with the financial market, and that financial market's functioning is important for the real sector as well. So understanding these financial markets is really important. If you don't understand them, you cannot invest. You cannot actually earn good profits. And if you do not able to just just park your savings in the right place, the world cannot grow. The economies cannot grow. In terms, all the growth and all the basically the financial investments which are depending on understanding of the financial market. To begin with, the financial markets definition, we just understand that what exactly are the markets. The market is a place where buyers and sellers exchange goods and services. You find different kinds of markets around. Like say, for example, when you go to the cloth market, you find people who are there willing to sell and buy clothes. When you go to the goods market, the books market, you just actually find people who are willing to trade in the books. Similarly, the financial market is a marketplace where people exchange financial assets. What are those financial assets? The financial assets comprise bonds, stocks, foreign exchange, derivatives, and many, many more. What do? They provide actually the financial markets provide an avenue for the businesses and investors to raise money and to grow their businesses and to make more money respectively. The world's growth is depending on the functioning of the financial markets, and that basically is something happening all over the world. Now, what exactly are the functions of the financial markets? As you know that the financial market is a market of the financial assets where people borrow and lend money. And this borrowing and lending takes place through different kinds of instruments. And these instruments are called bonds, stocks, and other kind of the instruments. Now, what exactly the financial market does? What are the functions of financial markets? When we say functions, we mean what exactly they do. The very first thing is that, as the market does, the market discovers the price through the demand and supply interaction. They are the people who actually demand the financial assets, and they are the people who supply the financial assets. So somehow these markets help the financial assets holder to determine what exactly should be the price of their assets. Should the price go up or they go down? That will be depending on the demand and supply of the markets. Now, what do these prices reflect? These prices reflect participants' collective assessment of the value of the assets. Another kind of the function that it performs, this price discovery, is crucial for the business investors to make informed decisions where to invest and where not to invest. Similarly, if you think about more of these financial markets, the functions of these financial markets also comprise, they provide you liquidity. The liquidity is the ability of the markets to transform your assets into cash. The liquidity that the financial markets provide is very, very important for the businesses because whatever the money they park in different kind of assets, they want it to liquidate at certain points of time. That liquidation basically requires them to have just to have some markets where they could go and exchange their assets with the money. So the financial markets actually are the places where you can convert your bonds, your stocks, and other kind of assets into money. So this is a very, very important function of this particular kind of a market. Like say, for example, when you buy a car and you don't have got any secondary market available where you can sell that car and get the money back of your car. you won't be interested in buying the car or parking so much money into the car. Because once if you park the money into the car and if you are not able to recover it in the times of need, you will not be able to just get the cash. And if you don't get the cash, you will not be able to meet with your needs. Another kind of the function which actually the financial market provides is a very, very important function. It transfers the risks. It actually, along with the diversification of the risk, they transfer the risk. They transfer the risk from the one person to another person. And they basically are very, very good in providing the hedges to the people. It provides every kind of hedge. There are so many people who are actually willing to buy your risk for a certain price. And if you are willing to sell, you can basically, sell your risk to the other people. Similarly, these markets are very good at providing the information. Information is the key in the modern world. If you really want to make informed decisions, you need information. And that information can be obtained through the financial market. So the financial market is a very, very good source of information. They provide you a lot of information about the financial health of the companies, financial health of the government, and everything related to the financial market. So that information is really key to make a good informed decisions. Now, that comes to the participants in the financial market. Who participate in the financial markets? Who can go to the financial market and make investments? Literally, everybody can go and everybody can be a part of this financial market. You can always get the benefit of this financial market and you can multiply your money very easily if you have got little bit information about this financial market. According to the different kinds of the financial markets, one of the kind is the individual investors. What do we mean by the individual investors? The individual investors are the people who basically are individuals in their capacity, like you and me. As an individual can go to the market and invest our money. Similarly, you have got institutional investors. There are so many institutions that actually receive money, like say, for example, mutual funds. The mutual fund is a kind of a pooled money kind of institution which actually pools money from different sources and invests that money somewhere, some places. They actually participate in the financial market and buying and selling of the financial assets. Similarly, the pension funds, the pensions that you basically get from the businesses and from different kind of institutions and organizations, that pensions are invested into the financial market. And the financial market is a place to provide them a very good source of returns on them, which actually multiplies the money which actually the different institutions have. Insurance company also have a lot of premium which they collect from their customers. What do they do with that premium? They invest that premium and they invest it through the financial market. So they basically are also institutional investors. Similarly, the money that we deposit with the commercial banks, and sometimes the money the commercial banks deposit to the central banks, I say, are also the part of the financial markets. They actually somehow come into the market and they just buy and sell bonds. They actually make investments. Similarly, the investment banks basically are the underwriters for the financial securities. They also provide help and they just play a role into the financial markets. Similarly, the government regulators, you must have heard about the central bank. The central bank regulates all the banking and financial institutions, all the banking institutions to be very precise. All the other kind of the institutions are managed by and controlled by and regulated by SECP, the Securities and Exchange Commission of Pakistan. So some of the financial institutions, which are the depository institutions, are controlled and regulated by the central bank, and other are regulated by the SECP. Now, how does this happen? You have got two options for making investments into the financial market. One is the direct finance and the other is indirect finance. You may choose any, it depends on you that how much risk are you willing to take and how much return do you want from your investments. The direct finance, as you can see, is the way of making finance directly into the market. And this making finance directly into the market exposes you to the risks. And that is what something you basically get exposed to when you actually go directly into the market. So, but the direct finance is one of the ways of actually, having finance or just actually making investments in the financial market. Another way is the indirect finance. Indirect finance, as the name suggests, you finance or you basically make investments in the financial markets indirectly. Indirectly means, say, for example, this diagram also represents this kind of indirect finance. Say, for example, you being a household business firm or government or foreigner may directly go to the financial market and invest. That would be a direct finance. But what you can do is as well, you can go through the financial intermediaries. These financial intermediaries actually, provide actually they help you in making the decisions, financial decisions. Here, when you make indirect finance, you don't invest directly, you just invest indirectly through the financial intermediaries. These financial intermediaries include commercial banks and similarly the mutual funds or pension funds or the insurance companies. In this way, you may basically have got the two ways of making investments into the financial markets. The one is direct and the other is indirect. And both of them basically have got their own pros and cons. Some people prefer direct finance over indirect finance, but some people prefer indirect finance over direct finance. In case of the direct finance, if you are on the one hand, you are getting all the returns, but you also have to expose yourself to the whole risks. But in case of the indirect finance, the other companies basically diversify your risk and they basically share your risk. So in that way, you have to decide on your own that what exactly is the way that suits your kind of risk orientation. Here we reach to the end of this lecture. Thank you for joining us. That lectures will be continuing and we shall be talking about the different aspects of the financial markets in the upcoming lectures. Please do tune like into this channel to for the further lectures and further kind of the information. Thank you for joining us.